All right, today we're going to peel back the layers on Kfintech. Their latest quarterly results just dropped, and they tell a really compelling story, one of serious growth and some very smart diversification. Let's get into it and break down what's really driving their success.
So let's just start with the headline number, shall we? A nearly 28% jump in revenue compared to this time last year. Now that's a huge signal of momentum, but the real story, the interesting part, is how they actually managed to do it.
So to really get our heads around this, here's how we're going to break it down. We'll start with those strong headline numbers. Then we'll uncover their massive international push. We'll also see how they're locking down their home market, take a look at their bets on the future, and then we'll wrap it all up with the single biggest takeaway.
All right, first up, let's dig into those top-line numbers that are making all the noise. This is really the foundation for the entire story we're about to tell.
Okay, so what you're looking at here is clear, solid growth on every level. Revenue is up that massive 27.9%. EBITDA, which is a great way to measure their core profitability, is up a very healthy 16.1%, and their profit after tax grew as well. The main point here, the company isn't just getting bigger, it's getting bigger in a profitable way.
And this chart just puts it all into perspective, doesn't it? You can literally see the leap they made, from around 2.9 billion rupees to over 3.7 billion in just 1 year. A jump that big really makes you wonder what's fueling it.
So where is all this growth coming from? Well, a huge piece of this puzzle is actually happening outside of India. Kfintech is making a really serious play on the global stage.
Just look at that number, 176.5%. I mean, wow. That is the incredible year-over-year growth in their revenue from international business. Folks, this isn't just growth. This is an absolute explosion.
It's the obvious question, right? A number that big doesn't just happen by accident. It has to be the result of a very specific and pretty bold strategic move.
And here's your answer. The acquisition of a company called Ascent Fund Services. This wasn't just a simple purchase, it was a total game changer. In its very first quarter, Ascent added almost ₹500 million to the revenue and has already signed on 47 new funds. This one move pretty much transformed Kfintech's entire global footprint overnight.
But hey, a global push is only half the story. While that international business is absolutely booming, Kfintech is also doubling down on its home turf in India. They're proving they can do both at the same time.
Let's start with their bread and butter, serving asset management companies. In that space, they've just locked in 2 major new clients, which just helps cement their dominance in the Indian market even further.
By signing on Nuvama Wealth and Monarch Net Worth, Kfintech is basically reinforcing its reputation as the go-to partner for investment firms. You know, the essential back-end operator. These are big wins that really solidify their advantage at home. And it's not just the big investment players. In their issuer solutions business, they brought on over 4,100 new corporate clients in just a single quarter. I mean, that is an incredible pace of acquisition.
And we're not just talking quantity here, we're talking quality. When you start winning contracts from some of the biggest names in the Indian tech world, like PhonePe and Zipto, it just goes to show your services are essential for the modern market leaders.
Their reach is expanding in other places too. Over in the pension sector, their subscriber base for the National Pension System, or NPS, has now officially crossed the 2 million mark.
And what's really amazing here is the context. Growing at 34% is impressive on its own, but look at this, it's nearly triple the industry's average growth rate. This tells you Kfintech is actively taking market share and becoming an even more dominant player in that space.
So performing well right now is one thing, but Kfintech is also clearly playing the long game. Let's take a look at how they're investing in the future of India's entire fintech ecosystem.
Okay, to understand this next move, you need to know about something called the Samarthi Foundation. Now, think of this group as the future rule makers for India's account aggregator system. It's a whole new framework designed to let you and I share our financial data securely and easily, which could totally unlock a new wave of financial products. Kfintech's board is putting 20 million rupees into Sahamati. And look, this is more than just money. It's a strategic move to get a seat at the table of a system that's probably going to define the future of finance in India.
So we've seen explosive international growth, a rock-solid business at home, and some really smart bets on the future. Let's just pull all these threads together now and look at the big picture.
You know, the company's own CEO, Srikanth Nadella, really said it best. The secret sauce to their success, even when the world feels uncertain, is their diversified business model. They're not just relying on one thing.
They've got multiple engines firing all at once. So here's the key takeaway. Kfintech's incredible growth isn't some accident. It's being powered by that game-changing Ascent acquisition abroad, while at the same time, its core Indian business just keeps getting stronger and winning market share. You combine that with a sharp focus on the future, and you got a really powerful formula for success.
And that really leaves us with one final thought. This quarter shows a company that is firing on all cylinders. It's executing a global strategy while fortifying its home base. So the big question now is, have they actually cracked the code for long-term, resilient growth in what's becoming a very complex market? Well, that's something we'll all be watching very closely.
Okay, so let's unpack this. Usually when we sit down for a deep dive, I've got, this messy stack of articles, maybe a few studies, a book or two. Today, I have exactly one sheet of paper in front of me.
Just the one. And honestly, sometimes a single image can tell you a lot more than 100 pages of text if you know how to read it.
And that is absolutely the challenge today. We are looking at a single snapshot. It's a financial chart for a company called Kfin Technologies, or Kfintech, on the National Stock Exchange. And I gotta say, my first impression, it doesn't exactly scream happy times. It looks a bit like a
crime scene.
Yeah, a crime scene. A very volatile one at that.
That's for sure. I mean, we're looking at a chart that goes from about June of last year all the way up to now, mid-February 2026. And if you just glance at the shape of it, the story is pretty clear. Gravity.
Gravity is a very polite way to put it. It looks like a mountain someone just fell right off of. But the reason we're talking about this chart, the specific one, isn't just the slide. It's that very last day. Right at the very end there, you see this sudden, almost violent gasp for air.
Exactly. That's a moment of what you'd call maximum tension. You have months of just pessimism, of selling, and it crashes head-on into this sudden spark. And our mission today is to decode that visual language. We're going to strip this chart down to lines, the bars, all of it, and figure out the psychology of what just happened.
Because that's really what it is, isn't it? It's not just numbers on a screen. It's thousands of people arguing over what something is worth.
Precisely. Every single tick on this chart is a human decision. It's fear, it's greed, panic, hope. It's all encoded right there in those lines.
All right, so let's set the stage. Before we get to that dramatic ending, we need the backstory. If we look at the big picture, the landscape of this thing, it really looks like it started with a party.
Oh, it did. A huge one. Look at the far left. Back in June, July of last year, that is what technical analysts call a parabolic move. The stock was just vertical.
I'm looking at the labels on the side here, the y-axis. It peaked way, way up there near the 1312 mark. That's the summit. If you owned it then, you felt like a genius.
That was peak euphoria. But the market has a very cruel way of humbling geniuses. Look how fast the story changed in August. That sharp drop, that's the hangover after the party.
It's a steep cliff. But then, for a little while, September, October, it didn't keep crashing. It just sort of meandered. It went sideways.
We call that consolidation. Yeah. But I think a better psychological term for it is the denial phase. All the investors who didn't sell at the top are just holding on. They're thinking, okay, the crash is over. We're stable. It's going to go back up now.
But the next leg up was actually a trapdoor.
It was. And this is so crucial for understanding the mood right now. Look at November. That's where the whole character of the chart just changes. The sideways stuff stops, and we start this slow, grinding decline that just goes on and on all the way through January. It's
not a straight line down, though. It's jagged.
It is, but look at the pattern of those jags. We call it a channel decline.
Yeah.
Every single time the stock tried to rally, you see those little green bumps in December. In January, it got slapped right back down and at a lower price than the time before.
Those are the lower highs you always talk about.
Exactly. Lower highs and lower lows. That is the textbook definition of a downtrend. It means the sellers are in complete control. Every time a buyer thinks, hey, this is cheap, a seller just comes in over the top and says, I don't care, I just want out.
Yeah.
That wears people down. It's attrition.
So by the time we get to February 2026, the sentiment is just awful. Anyone who bought in the last 6 months is losing money. They're exhausted.
They're demoralized. And you need to understand that context, because it's what makes the drama of this final candle so important.
Okay, let's do it. Let's zoom right in on the now, the far right of the chart. Mid-February 2026. This is the bit that caught my eye because it just looks so different from everything that came before it.
This is where we get into what's called candlestick analysis.
Yeah.
And for anyone listening who might not stare at these all day, a single candle tells you 4 key things about one day of trading.
The open, the close, the high, and the low. So let's run the numbers for this specific day because they tell a wild story. The stock opens at 968 point now.
Which was already a gap down from the day before. It opened weak. The day started with fear.
Right. And then at some point, the floor just completely falls out. It drops all the way down to a low of 952.00.
And 952 is such a critical number. I mean, put yourself in the shoes of someone holding that stock. You watched it bleed for 3 months. You wake up, it opens lower, and then it drops another, 15, 20 points? What are you doing?
I'm panicking. I'm thinking this thing is going to zero. I'm hitting the sell button just to make the pain stop.
Precisely. That move down to 952 is what we call capitulation. It's a shakeout. It's designed to flesh out the last of the weak hands. The market pushes them to their absolute breaking point.
But, and this is the big plot twist, the bears didn't win the day.
No, they did not.
Because look at the high. By the end of the day, the stock had rallied all the way up to 1040.00, and it finally closed on 1000.90.
Just think about the sheer force of that U-turn. It went from looking like a complete and utter breakdown to closing way higher than it opened. And visually on the chart, this creates a very specific shape. You get this green body at the top and then a long, thin line sticking down from it.
It looks like a mallet or a hammer.
That's exactly what it's called, a hammer candle. And that long lower line, the handle of the hammer, that is one of the most powerful signals you can find. It represents one thing: rejection.
Rejection of what?
Rejection of lower prices. The market tried to value Kfintech at 952. The sellers put that price out there. And the buyers, probably big institutional money, stepped in and just said, no, that is the wrong price. That is too cheap. And we are buying everything you're selling at that level.
So that long tail at the bottom is basically the footprint of a fight that the bears lost.
Perfectly put. It is visual proof of aggressive buying.
I want to stick on that closing price, though, 1000.90. It feels suspicious to me.
Why so?
It's just too perfect, isn't it? 1,000 is such a massive, round, psychological number. If it had closed at 998, it feels like a failure. But 1000.90, it feels like they specifically fought to get it back over that line.
You are hitting on a huge part of how markets actually work. Round number theory is a very real thing. Human beings, we're obsessed with zeros. We don't really care about 994. We care about 1,000. It's a mental barrier.
So when it dipped to 952, it shattered that barrier.
It did, and that terrified people. But to reclaim it by the end of the day, that's a statement. That's the bulls planting a flag and saying, we still own this fortress.
Yeah.
Closing above 1,000 forces everyone who is bearish to stop and reevaluate.
Okay, so a hammer candle, we reclaim a big psychological level. Sounds great. But one day doesn't make a new trend, right? I mean, I'm sure you could find other hammer candles that didn't work out.
Oh, absolutely. A candle by itself is just a signal. It's not a confirmation.
Yeah.
To get that, you have to look at the context. You have to read the tea leaves, and that's where the other indicators on this chart come in.
Right. Let's talk about the geometry here. I see these two wavy green lines that form a sort of channel around the price. They look like riverbanks.
Those are the Bollinger Bands.
I love that name. Sounds like a 70s prog rock group. And now, the Bollinger Bands.
It does, doesn't it?
Yeah.
But they're a volatility tool. They're based on standard deviation. And without getting too deep in the math, the idea is that statistically, something like 95% of all the price action should happen inside those two green lines.
So when the price goes outside the line...
It's an anomaly. It's an extreme event. Now look at the days leading up to our hammer candle. Where was the price sitting relative to that lower green line?
It was riding it, hugging it tight. In fact, on that day, it dropped to 952. It punched right through the bottom of it.
Exactly. It pierced the lower band. In trader talk, we'd say the rubber band got stretched too far. When price moves that far away from the average, a snapback, a reversion to the mean, becomes statistically likely. The harder you stretch it down, the harder it snaps back
Please
up.
like and
So the
subscribe.
bounce wasn't necessarily because of some amazing company news. It was almost like a law of physics. The rubber band just had to snap back.
In the short term, very often, yes.
Yeah.
Market mechanics can completely override fundamentals. The algorithms, the trading bots, they are programmed to see price below lower Bollinger Band and just automatically trigger buy orders.
Okay, so the rubber band theory explains the bounce, but here's where I have to play skeptic. I see another line in this river, the red one, running right down the middle.
That's the moving average. It's probably a 20-day simple moving average. It's the center line.
Right. And looking at the chart, despite this heroic recovery on the last day, the price is still sitting firmly below that red line.
It is. And this is the cold shower for the bulls. This is the reality check.
Explain that. Why is that one line so important?
Well, In a healthy uptrend like the one back in June and July, the price surfs on top of that red line. The line acts as a floor, its support. But ever since November, what's been happening?
The price has been drowning below it.
Correct. And when the price is below the average, that red line flips. It's no longer a floor, it becomes a ceiling, it becomes resistance. Every little rally in December and January hit that red line and just bonked its head and fell back down.
So even though we're excited about the hammer at the 1,000, until we get back above that red line, we are still technically in a downtrend.
Precisely. We're in what you'd call a counter-trend rally. We're moving up, but we're swimming against the main current. The real test is the next few days. Can it punch through that red line? If it fails there, we probably roll over and retest the lows.
It's like the final boss in a video game. You've beaten the minions, but you haven't beaten the red line boss yet.
That is a perfect analogy. The red line is the final boss.
Okay, let's look under the hood a bit. I want to see if this move has any real power behind it. At the bottom of this new vomit chart, we've got two other windows. The first one is labeled RSI 14.
The relative strength index?
It's just a squiggly white line. For those of us who aren't initiated, is this like a speedometer for the stock?
That's a good way to think of it. It's like a momentum gauge that tells you if the engine is running too hot or too cold. It goes from 0 to 100. Anything above 70 is overbought, too hot. And below 30 is oversold, too cold.
And where has Kfintech been lately?
Well, look at the valley it just climbed out of. During that downward grind in January and early February, that white line dipped really low. It got into that oversold territory below 30. That means the selling pressure was just intense, maybe unsustainable.
And on the day of our hammer candle, where is it now?
Look at that shape. It's hooked sharply upward. It's moving away from that danger zone, and it's hovering somewhere around the 40 to 50 range now.
So what does that tell us?
It tells us that momentum is trying to shift from negative back to positive. It's not overbought yet, not by a long shot, but the direction is what's key. It's pointing up. It confirms the buyers are finally starting to wake up.
Okay, so the speedometer is moving up. What about the fuel in the tanks? I'm looking at the volume bars at the very, very bottom, these vertical sticks.
Volume is the energy of the market. I like to call it the truth serum.
The truth serum, I love that. Why?
Because price can lie. A stock price can move up 5% on super low volume just because nobody's selling right then. That's a hollow move. It's fragile, but volume. Volume is money actually changing hands. It represents conviction.
And looking at the bar for our hammer day, it's green, and it is noticeably taller than all the bars that came before it.
Exactly. That volume spike is absolutely crucial.
Right.
It tells us that the move from 952 back up to 1,000 wasn't some kind of glitch. A lot of shares were traded. Big money likely stepped in to defend that level.
So this wasn't just a few small retail guys like me nibbling at the bottom.
Unlikely. High volume on a reversal day like this almost always implies institutional activity. Mutual funds, hedge funds, the so-called smart money. They saw that price and stepped in with real size. When you get a bullish reversal candle plus a volume spike, the probability that you found a real bottom goes up significantly.
It's like a whole crowd shouting, "Enough!" instead of just one person whispering it.
The volume gives weight and legitimacy to the price action.
All right, so we've got the landscape, the indicators, momentum, energy. Let's try to synthesize this. I see the watermark Nuvama on the chart, which is the platform this is from, and it's giving us a very specific view. What's the final verdict here?
I think if you connect all the dots, what you have is a conflict. You have a mixed signal, which is actually very common in trading.
Walk me through the conflict. Give me the case for the prosecution and the case for the defense.
Okay. On the bearish side, the trend since November is undeniably down. The price is still below that key red line, the moving average. The bears still have the structural advantage on their side.
That's a strong case. What's the defense?
The bullish argument is that we have an incredibly powerful reversal candle on the most recent day. We have a clear rejection of lower prices. We have the RSI momentum indicator bouncing off the bottom. And most importantly, we have high volume to confirm that buyers are serious at these levels.
So it's a battleground.
It is a fierce battleground right at that 1,000.90 price point. The stock is desperately trying to carve out a floor. It's trying to say, this is it. We are not going any lower.
So if you're a trader looking at this, and I know we don't give advice, but just purely from a technical setup, how do you even approach this?
Well, it really comes down to risk management. And the chart actually gives you very clear guideposts now. Because of that hammer candle, you know exactly where the floor should be.
At 952.
Right. So if you're bullish, if you think this is the bottom, Maybe you buy somewhere near 1,000. But your stop loss, the point where you admit you're wrong and you get out, has to be just below 952. You're risking about 50 rupees per share.
And the potential reward.
Well, the first target is that red moving average line. But if it breaks through that, the next target could be the upper Bollinger Band, or maybe even those old resistance levels way back up near 1,100 or 1,200.
So you're risking 50 points to potentially make 150 or 200.
Exactly. That's a 1-to-3 or 1-to-4 risk-reward ratio. That is a trade that professional traders will take all day long. They don't know for sure if it will go up, but the math of the bet finally makes sense.
It's interesting how you frame that. It's not about predicting the future. It's about structuring a bet where the odds are in your favor.
Technical analysis is never about gazing into a crystal ball. It's risk assessment. And this chart is telling us the risk of more downside has decreased, simply because the buyers finally showed their hand at 952.
I want to zoom out just one last time. We've been very focused on the lines and the math, but let's talk about the company for a second. Kfintech Q. They're a financial services tech company, right? They handle things like mutual fund registries, data processing.
Yeah, they're essentially the plumbing of the financial system.
Right. And does that matter? Does the name on the top of the chart actually matter?
Well, that's the great philosophical debate, isn't it? A pure chart technician would say, no, absolutely not. I could take the name off, call it corn futures or Bitcoin, and my analysis would be identical.
Because human psychology is the same, whether you're trading tech stocks or tulip bulbs from the 1600s.
Fear looks the same in every single asset class. Greed looks the same. That vertical drop in August, that was panic. Doesn't matter what the company's earnings were. The chart just captures the raw emotional reaction.
Okay, so to bring this all together, to recap the journey of Kfintech we've seen on this chart, we had the euphoria of the summer peak way up at 1,300, the confusing sideways shuffle in the autumn, the slow, grinding winter of despair that took us below 1,000, and now finally this little spark of life in February.
That's the narrative arc, from greed to fear to potential hope.
And it really drives home that you can't just look at a price in isolation. If I just told you the stock's at 1,000, that means nothing. But knowing it came from 1,300, went all the way down to 950 and fought its way back, that tells you everything about the current sentiment.
Context is everything. The price is just a number. The chart is the story. And right now, that story is a total cliffhanger.
And that brings us to the end. We've decoded the lines, the bars, the squiggles, but I want to leave you, our listener, with one last thought to mull over. We talked about that number, 1,000. The stock closed at 1,000.90.
The psychological fortress.
Exactly. And my question is this: how much of our entire economy is just held together by these arbitrary patterns we see? Is Kfin Technologies actually worth 1,000 rupees a share? Or is it worth 1,000 simply because thousands of primates staring at glowing rectangles decided that 4 digits just feels safer than 3?
That is the ultimate question. Are we rational actors calculating future cash flows? Or are we just pattern-seeking mammals desperately looking for some kind of order in the chaos?
Makes you wonder if the invisible hand of the market is really just our own collective obsession with round numbers. Something to think about. Thanks for diving deep with us today. We'll catch you on the next one.